All right, class, welcome. Today we're going to tackle a form that is absolutely fundamental for anyone working in the tax world. I'm talking about the T5 information return. And believe me, by the end of this, you're going to know it inside and out.
So, let's jump right in.
So, I want you to think about this for a second. As a tax pro, you're going to see all sorts of payments flying around. Interest, dividends, royalties. But when does paying that money out actually mean you have to tell the CRA about it? That's the core question, right? And the T5 return is the answer. It's really the tool the CRA uses to make sure none of this investment income just disappears. We're going to pull back the curtain and see exactly how it works.
Okay, here's our game plan for today. First, we'll cover the basics of the T5. Then, we'll get into the nitty-gritty of when you absolutely have to file. After that, we'll do a box-by-box teardown of the T5 slip itself. We'll talk deadlines, penalties, the scary stuff, and we'll finish up with some special scenarios you're likely to run into. Sound good? Let's get started.
First things first, let's lay the groundwork. What is a T5 return? And who exactly has to worry about filling one out?
It's best to think of the T5 as a three-way handshake. You have the person or company paying the income, the person receiving it, and the CRA. The T5 is the document that connects all three. It tells the recipient, hey, here's the investment income you earned. And at the same exact time, it's sending a copy to the CRA saying, just so you know, we paid this person this amount. It's all about transparency and make sure everyone is on the same page when tax time rolls around.
Okay, so that leads to the next logical question. When does this obligation actually kick in? This is super important because, you don't have to issue a T5 for every single cent of interest that gets paid. There's a threshold.
And the CRA is actually pretty specific about this. Look at this breakdown. On one side, you have things like dividends, interest from bonds, royalties. That's definite T5 territory. But on the other side, look at the exceptions. The big one is that $50 rule we're about to talk about. But also, think about a private mortgage between two individuals. No T5 needed for that. Or payments to non-residents. Nope, that's a whole different form, the NR4. Honestly, knowing what not to file is just as important as knowing what you have to. So here it is, the magic number, $50. If the total investment income you pay to one single person for the entire year is less than $50, you usually get a pass. You don't have to file a T5 slip for them. It's what we call a de minimis rule. It's basically the government's way of saying, look, let's not create a mountain of paperwork for tiny little amounts. It just makes sense.
Okay, time to get our hands dirty. This is where we move from the why to the how. We are going to dissect the T5 slip itself, box by box, and we'll start with what is often the trickiest part for most people, dividends.
All right, first up, we have what we call dividends other than eligible, or what most of us just call non-eligible dividends. These usually come from smaller, private Canadian corporations. Now, it's not as simple as just one number. You've got three boxes to deal with. Box 10, that's the easy one. It's the actual cash that landed in the person's bank account. But then you get to box 11. This is the taxable amount, and it's grossed up by 15%. So what does that mean? The government basically inflates the number for tax purposes to account for the fact the corporation paid a lower tax rate. Then, to balance it out, box 12 gives you a dividend tax credit. It's a bit of a dance, but there is a logic to it.
Now let's look at the other side of the coin, eligible dividends. These are typically from big public companies, the ones traded on the stock exchange. And the math here is totally different. The gross up is way bigger, 38%. And because of that, the tax credit you get in box 26 is also much larger. So why the difference? It's all about something called tax integration. The system is designed so that in the end, you pay less personal tax on these eligible dividends because the corporation that paid them already paid tax at a much higher rate. It's all about fairness, at least in theory.
This table really puts it all into perspective, doesn't it? You can see the different sources, the different boxes, the different gross-up rates all side by side. For you, as future tax professionals, memorizing this is, well, it's not optional. This is your bread and butter. And like I said, this whole system, with its gross-ups and credits, is what we call tax integration. The goal is to make sure a dollar earned inside a corporation and paid out as a dividend is taxed at roughly the same total rate as a dollar you earned directly as salary. It's a true cornerstone of our tax system.
Of course, a T5 isn't just about dividends. There are other key boxes you'll use all the time. Box 13 is for your standard, straightforward interest income. Easy enough. Boxes 15 and 16 are huge if your client has foreign investments. You have to report that foreign income and any foreign tax they paid, all converted to Canadian dollars. That's how they claim their foreign tax credit. And then there's box 22, the recipient's ID number. You absolutely have to get their SIN, or their business number. The CRA is very, very strict about that one.
Okay, great. So you've filled out the slip perfectly, you've double-checked all the boxes. Now what? How do you actually get this thing filed? Let's get into the nuts and bolts of the deadlines and how to submit it, because the rules here are very, very specific.
The deadline is simple, and it is non-negotiable. The T5 return has to be filed with the CRA, and the slips have to be in the hands of the recipients by the last day of February of the year after the tax year. So for the 2025 tax year, that deadline is the end of February 2026. You need to burn this date into your memory. It's one of the most important deadlines in the entire tax compliance cycle.
Now, this next point is a big one. Seriously, pay close attention, because this trips up so many small businesses. If you are filing more than 5 T5 slips for a given year, so 6 slips or more, you have to file them electronically. You cannot file them on paper. If you try to mail in a stack of 6 paper T5 slips, you're going to get hit with a penalty. Guaranteed.
So what are your electronic options? Well, the CRA gives you 2 main paths. The first is called web forms. You can access it right on the CRA website, and it's perfect if you only have a handful of slips to file, say up to about 100. The other option is internet file transfer. This is for the heavy hitters, big companies, accounting firms, who use professional tax software. The software creates a special XML file that you just upload directly to the CRA. Both methods work great, it just depends on your volume.
Okay, so what happens if you don't follow these rules? What if you miss the deadline or you file on paper when you really shouldn't have? Well, the consequences can be pretty steep. The CRA does not mess around when it comes to these information returns.
And I wasn't kidding about that electronic filing rule. Just look at these penalties. They start at $125 and go all the way up to $2,500 just for filing on paper when you shouldn't have. And here's a key point. This penalty applies per type of return. So if you mess up and improperly file 10 T5s and 10 T4s on paper, you're looking at 2 separate penalties. Ouch.
Now, it's not all doom and gloom. There's a potential escape hatch, but it's a small one. The CRA has something called the taxpayer relief provisions. This basically gives them the power to cancel or waive penalties if, and this is a big if, you couldn't meet your tax obligations because of circumstances that were completely beyond your control. And there's a formal process for this. You have to fill out Form RC-4288 and submit a request. But let me be crystal clear. The bar for this is incredibly high. We're talking about things like a fire destroying your records, a sudden serious illness, that kind of extraordinary event. Just forgetting the deadline or being disorganized is not going to cut it. This is a tool of last resort, not an excuse for being careless.
All right, to wrap things up, let's cover one more scenario that I see trip up new tax preparers all the time. This is a really common point of confusion, so listen up.
It all comes down to one simple question: residency. Is the person you're paying a resident of Canada? Use a T5. Are they a non-resident? Then you have to use a completely different form, the NR4. And the NR4 is a whole different beast. It involves withholding tax right off the top and remitting it to the government. So getting this distinction right is absolutely critical.
And that's the T5 in a nutshell. But before we finish, I want you to think about the big picture here. This whole system, it's more than just paperwork, right? This rigorous reporting is what holds our entire self-assessment tax system together. It's the network of checks and balances that allows the CRA to trust the numbers that people put on their tax returns. So when you're preparing a T5, you're not just filling out a form. You're participating in a system that ensures fairness and integrity. Mastering this is a huge step toward becoming a true tax professional.